In today's video, I'm going over 5 of my favorite stocks I'm buying right now and why I'm buying them. I've analyzed over hundreds of companies and these are my top 5. Don't be like John, watch this video from beginning to end all the way through so you can see my full analysis on each of these companies. Don't just blindly see, oh, this person's buying this company, I'm going to copy them and buy it. You need your own conviction. This is a good baseline to see how I research some of these companies to add on to your own research, and then you make your own decision at the end of the day. It's your life. We're going to go over some of the financials, and don't worry, I'll explain what all those numbers mean, some recent news, and where I think the company is headed. The first company is Facebook. We all know what this is. If you use WhatsApp or Instagram, you're using Facebook, and we know what happened on Monday. People were panicking. There's a bunch of memes on it. Even Twitter noticed Facebook is down. Hello, literally everyone. And then Instagram replied, hi, happy Monday. And WhatsApp replied, hello. We saw that the stock dipped about 5% that day, which was a great buying opportunity. And Facebook's not just a social media company. They also are working on these Ray-Ban glasses. They partnered with Ray-Ban. They have cameras right here. I don't know if there's like a demo video we can watch. Oh, okay, here we go. So the Ray-Ban glasses, they record stories. People are saying it's pretty cool. Look at this girl doing flips, recording stories. There's the Oculus VR headsets. This has been out for a while, virtual reality. This is a whole different industry that they're diving into. So currently Facebook is at $332.96. At the 52-week range, we can see the bottom was 244, the high was 384. This is the first thing I like to look at, which is their revenue. So go over to their income statement, look at their revenue. This is in millions, so this is $27.6 billion that they pulled in. This is all the money they brought in, not the gross profit. Revenue is all the money that came in. In December of 2017, at the end of the year, $40.6 billion, 2018, $55.8 billion, 2019, $70.6 billion, and the end of 2020, $85.9 billion. And as of right now, the trailing 12 months, $104.7 billion. It's funny how in 2018, I was making videos on Facebook showing how the revenue was growing and saying it was going to keep going up aggressively fast. 27 billion. 2017, 40.6 billion. This company is growing at an extremely fast pace. And it's done that, and I think it's still going to do that over the next 5-10 years, which is why I really like the stock. Now, if you want to see the gross profit, which is also very important, I look at that as well. We can see it's steadily been going up. 23 billion, 35, 46, 57, 69. And 84 billion. Now let's take a look at the valuation. The market cap is at $967 billion. And for those that don't know, the market cap is just the number of shares outstanding, the amount of shares floating around, and the share price multiplied together. That gives you the value of the company, which is trading at $967 billion. So when you buy one share, you're essentially agreeing that Facebook is worth $967 billion as of right now. The PE ratio is at 24.23. 24.23 for Facebook is low. In my opinion, that's low. The PE ratio, for those that don't know, is it showing? Oh, it shows it. That's cool. It's the price to earnings ratio using the trailing 12 months, exactly what I'm saying. So the price of the stock divided by the earnings gives you the PE. That's one metric you can use to see what the value of a company roughly is, like how much of a deal you're getting. You can measure that PE against other companies and just use it as a metric. A lot of people love looking at the PE, including myself. And then we have the PEG ratio, which is at 0.37, which is really good. The lower the PEG ratio, the better. It's the PE ratio over the growth rate, the earnings growth rate. So how fast the earnings are growing, and then the PE ratio. And then we have a price to book ratio of 6.67. And let's look at the profitability. 80.98% gross profit margin. That's ridiculous. That's really, really good. And only a software company like Facebook can pull that off. All right, let's look at their balance sheet. How much cash do they have? $64 billion in cash. Their current ratio is at 5.43. The current ratio, by the way, is the current assets over the current liability. Let's look at what the analysts have to say about Facebook as well. Just for fun. I like to do this for fun. On Yahoo Finance, the Yahoo analysts believe that Facebook is undervalued. It has a 1.9 rating, which is slightly above a buy, below a strong buy. The second stock is Apple, which is a monopoly in my opinion. They are a cult. Anyone that has an iPhone, you understand this. When you text someone and the message is not blue, you get angry. It's a cult. Everyone needs to have iMessage. You need to be on my iCloud. I'm on Apple Music. I'm watching the Apple TV for exclusive shows. Apple is its own monopoly, but they'll never admit it. Of course, they'll never admit it in court. But let's go over the company. So they released the new iPhone 13, which is a great looking phone, but I think iPhone 13, iPhone 12, 11, it's all the same thing. But People are saying it's better, specifically the big YouTuber Marquise Brownlee, better than you think. It's probably better than I think. I haven't watched this video. Honestly, I don't care. I have an iPhone 12. Very happy with it. A lot of people that have the 11 and below will probably upgrade just because of 5G. The iPhone 12 and 13 both have 5G, so we are going to see a new cycle, and that'll probably lead to more iPhone sales. Apple iPhone ownership among teens holds near record high. Exactly like I said, a monopoly. Especially most teens are using Apple iPhones, and these are teens, so when they grow up, they're going to be used to iOS, the Apple ecosystem. They've got so much growth ahead of them. Apple Music versus Spotify, again, Apple's not just competing with Samsung for phones, they're competing with Spotify for music, with Netflix, with the Apple TV, even with Tesla, with the Apple car. I think that's the next article. This is just Apple, and Apple has so much money, which you'll see. We'll look at the financials. We haven't even looked at the financials yet. Apple, $141, 52-week high is at $157. 52-week low at 107. It's closer to the 52-week high. I still think Apple is cheap even at these prices. First thing, income statement. Just like we did with Facebook, let's look at the revenue. $215 billion. That gives you an idea of how big Apple is. You saw how much money Facebook was making. Look at Apple, $215 billion in 2016, $229 billion, $265 billion in 2018, $260 billion in 2019, and $274 billion in 2020. And in the last 12 months, $347 billion. They are growing, and you look at their gross profit, $84 billion, $88 billion, $101 billion, $98 billion, $104 billion, and now $142. Let's look at the valuation. The market cap is at $2.3 trillion. Their PE ratio, which we went over, is the price to earnings ratio, is at a 27.24. Now you might think, okay, 27.24, that's kind of high. It's not high at all for Apple. In my opinion, a tech company like Apple, with all the things they're working on, the Apple car and their other projects that aren't even making money yet, that's a ridiculously low PE. I mean, that's the same PE as like McDonald's. Here, maybe I'll just open a new tab real quick and just show you this. All right, we are experiencing an outage with the camera. So not only was Instagram, Facebook, and WhatsApp down yesterday, my camera seems to be overheated. This will be a voiceover from here on out. Let's just carry on with the video. I was talking about McDonald's PE ratio. Look at it at a 26.45. And then when you go right over to Apple, Apple's at a 27.24. And McDonald's doesn't have the same growth projects ahead of it as Apple does. So that's a huge discrepancy. I just wanted to bring that up. The balance sheet, $61.7 billion in cash, a current ratio of 1.06, so not bad. We always want that to be above 1. The analysts are saying it's near fair value. And where's their price targets? Let's go down here. 167, and it's currently at 141. So even the analysts think this is somewhat of a deal. So let's move on to the next stock, Amazon, where everyone shops. There's Amazon Prime, you watch your movies, you buy whatever you need, get it delivered same day, same hour. Before we talk about Amazon, I want to go into their financials right away so I can explain something to you, because a lot of people seem to miss this. So the first thing is, okay, they're priced at $3,200. Their 52-week high was 37. Their 52-week low is 2,800. So it's actually closer to the lower end. So even if you were looking at the chart, you would think this is a deal just off the chart. And for fun, the short interest is at 1.17%, which is also really low. So you know the market is optimistic about this stock in general. We go over to the next tab, Amazon. Let's go over to the financial statements, the overview income statement. The first thing we always look at, the revenue. How much money are they bringing in? $232 billion in 2018, $280 billion in 2019, $386 billion in 2020, and $443 billion in the last 12 months. Gross profit, same thing, $47 billion, $65, $93, $114, $152, $180 billion in the last 12 months. So this company is still growing. Even though it's already massive, it's growing even more. Let's look at the valuation. So the market cap is at $1.6 trillion. Their PE ratio is at 55. Now, a lot of value investors, people that just look at metrics, will freak out here and say, oh my God, Amazon is at a 55 PE ratio? That's so expensive. But you're not taking into account where Amazon is putting their money and why their earnings are so low, which I'll get into in a minute. But let's go over the rest first. The PEG ratio, price to earnings growth ratio, is at 0.46, which is really good. You know the company's growing. Price to book ratio is at 14. Let's go down to the profitability. Their gross profit margin is at 40%. Total cash, $89 billion. Current ratio of 1.2, which is good. It's near fair value. What is their price target on this? $4,152. So even the analysts think Amazon is a good deal, or at least it's near fair value. I think it's undervalued, and I'm going to tell you why. I literally made a notepad just for Amazon. So right here, Amazon stock notes, disclaimer, this does not apply to every company. It doesn't. It has a high PE of 55. Let's address that. The S&P is at 20. So you would think, why don't I just buy the S&P instead of Amazon? Amazon's PE is so high. The PE ratio is based on just the next 12 months. It's not looking 3, 4, 5, 10 years ahead. It's not a good indicator for companies with a longer timeline, such as Amazon. Earnings will grow rapidly because of projects in the background that are not currently earning money, but will in the future. This will drop the PE ratio. Everyone missed Amazon a decade ago, simply due to this metric alone. Not considering the projects in the background, strictly looking at current PE, it looks overpriced if you just looked at the PE. But the difference is Amazon pours money into research and development. Some of the background projects that will earn huge in the future is their autonomous vehicles. They're huge in media. They're taking over sports media. The Amazon Prime memberships with 200 million subscribers. That's very powerful right there. Logistics and infrastructure being built out. They have over 1 million employees. Just think about how expensive 1 million employees is. Driving vehicles and warehouse workers, those are all going to be automated. They're going to get rid of all of them. These jobs are all going to be automated, and that will skyrocket the earnings, which will then do what? Drop that PE ratio way down. The key point here is the valuation is deceiving because they are reinvesting into other business segments that will be profitable later in the future beyond 12 months. And this leads me to our next stock, so it can help you understand that, which is Tesla. But by the way, this is still Amazon we're looking at here. I just want to hammer this down on the PE ratio. Back here, look, in 2014, everyone missed out on Amazon, including Warren Buffett. They saw the price at $336, and right now you're looking at it like, wow, that's so cheap. That's such a cheap price. When it was priced at $336 per share, the PE ratio was at 525. Anybody looking at this stock would say that is ridiculously overvalued. I would never buy this stock. And you know what this reminds me of today? That reminds me of Tesla. Because Tesla's PE ratio is ridiculously high right now, and people are saying the same thing, but I think they're going to miss the boat. And Tesla is the next stock we will be talking about. So as you can see, the earnings were sometimes negative, sometimes positive, because they were reinvesting most of their money into projects, which later started bringing revenue, and the compounding effect kicked in, and you see this hyperbolic exponential growth. Just look at it shoot up as it's still shooting up to this day. As of June 30th, 2021, earnings per share jumped to $57. When you look back, just 5 years ago, it was at $4 per share. From $4 to $57, more than 10x gains in earnings per share. All right, let's get into the next stock, which is Tesla. So most people think Tesla is just a car company because it's obviously a Tesla. So what do you think? Oh, it's just an electric car company. Tesla isn't just an automotive company. It's an energy company, an AI company, and much more. These aren't just cars on the road. They are robots on wheels. Tesla is leaps and bounds ahead of all of its competition. All the data from their drivers being collected gives them a massive advantage. Tesla is just beginning to experience that extreme growth from all the projects they've been investing in over the decades. Anyone that owns a Tesla is always hyped about it. Just think about that. But let's go on to some news about Tesla, because I know a lot of people are freaking out about this right here. Cathie Wood just dumped $270 million in Tesla. 3 cheap EV stocks to buy instead. This is a FUD article, Fear, Uncertainty, and Doubt. Cathie Wood, I have a video saved to play right now just to explain. Here, let me I'm going to have to edit this in. I'm going to edit this into the video.
I can buy up to 10% position in any one fund, and then let it run. We'll let it run to 12 or 13%, at which point we'll take profits. We get a lot of questions about how can you be so positive on Tesla and be selling it? Well, I sold it just in the way I described, but it never lost the #1 position in our funds.
It's just simple portfolio management. She loves the stock, but she can't let it get too big because she has certain rules to manage a portfolio. It's simply that. She's still bullish on it. She still has high price targets. Nothing has changed. All right, let's get into the financials. Tesla's at $780 with a 52-week high of 900, 52-week low of 379. I still think even at 780 right now, Tesla is cheap. Let's get on to the income statement. Here's Tesla's revenue. 2016, $7 billion. 2017, $11 billion. 2018, $21 billion. 2019, $24 billion. 2020, $31 billion. And the last 12 months, $41 billion. And I think this is going to keep skyrocketing further and further. If we look at their gross profit, $1.5 billion, $2.2 billion, $4 billion, $4 billion, $6.6 billion in 2020, and $9.2 billion Now let's look at the valuation. Market cap 767 billion, PE ratio 411. And just like I mentioned earlier with Amazon, back in 2014, Amazon had a PE of 500. People thought it was overvalued looking at just that metric. They didn't understand Amazon was investing in other business segments that were not yet profitable, just like Tesla has been doing all of these years and continues to do. The PEG ratio is at a 1.06, which is actually not that good. The price to book's at 31. So obviously on paper, this company looks way overvalued. The income statement, the revenue, we already looked at that. The total cash, 16 billion. Current ratio, 1.5. Now let's look at what the analysts have to say for fun. Of course, Tesla overvalued because they're just looking at this ridiculous PE and there's just no way of justifying it to them. But in 2014, you couldn't justify Amazon's 500 PE. And now we look here at their price target, 687. Just a few months ago, that was at 500 and it was at 300 about 7-8 months ago. They keep raising it as Tesla keeps skyrocketing up. I think Tesla is going to keep going up. But hey, that's my opinion. I'm buying Tesla. The public portfolio, by the way, for all the OG subscribers, it's all Tesla. And the final stock of the day. This video's going on way too long. I need to cut this quick. Google stock. It needs no introduction. You're watching this on YouTube, which is owned by Google. We're on Google right now. We all know how great Google is. Let's get right into the financials. 1 year chart. The all-time high was 29.25. 52-week low was 14.33. Let's look at the income statement, the revenue. Google is the best the best company to look at their financials. The revenue, 90 billion in 2016. 110 in 2017, 136 in 2018, 161 in 2019, 182 in 2020, and $220 billion in revenue in the past 12 months. Gross profit, 55 billion, 65, 77, 89, 97, $122 billion in profits in the last 12 months. Google is an absolute beast. I don't know any other company that can compete with Google when it comes to their financials. Maybe Microsoft, but Google is insane. Their market cap, $1.8 trillion. Their PE ratio at a modest 29. For what Google is, 29 is not expensive. And again, like Amazon and Tesla, their PE ratio can be deceiving. Google is still growing. Google has tons of projects it's working on in the back end that aren't profitable yet. Their PEG ratio is at 0.28, which is insanely good. They're growing so fast. Their earnings are just growing and growing. Their price to book is at 7.5. The gross profit margin is at 55%. The current ratio is at 3.15. I love that current ratio. Total cash, $135 billion. That is ridiculous. That is the most cash I think any company in the world has right now. 135 billion cash on hand. If I had to invest in just one stock and I couldn't pick any other one and I wanted the safest stock that would probably outperform the S&P, it's going to be Google. Just plain and simple. Now for fun, let's see what the analysts have to say. Near fair value, and what's their price target? 31.64. So even the analysts, they got this right in my opinion. That's the end of this video. Don't forget to like, comment, subscribe. I gotta go. Hit the notification bell so you know when the next video comes out. I'll be posting more regularly now. And until then, I'll see you in the next one.